After you pay your essential living expenses each month, there's a multitude of different ways that you can invest your money or save your money, depending on what your goals are, whether it be a savings account at the bank, your 401k, a brokerage account, etc. So in today's video, I'll discuss what I call the financial order of operations, which I believe is the optimal order in which you should invest your money to give yourself the best chance of building wealth long term. So let's dive into it. Hey everyone, my name is Jake Scalhorn, Certified Financial Planner with Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. So first place that you should be putting your money, again, after you pay your basic living expenses each month, is your 401k up to your company match. So the reason this is number one is because this is free money. So for example, if you earn $100,000 a year, your company matches you dollar for dollar up to 5% of your pay. That means if you put in 5%, your company is going to put in another 5% for you into your account. So that $5,000 immediately multiplies to $10,000 because of the company match. So there's no other place where you're going to get that instant risk-free return automatically. So number one is your company's 401k match. If you're not contributing up to the percentage that they match, you're basically leaving money on the table. Number two on the list is an emergency fund. So you want to have at least 3 to 6 months worth of your living expenses in an emergency fund at a bank, either in your regular savings account or ideally a high yield savings account. Right now, high yield savings accounts can earn you 4 to 5% annually, which is risk-free. So that's the best place to park any emergency savings. Again, these are accounts where you can access money quickly and easily in the event of an unexpected expense. So let's say you have your AC unit go out or your car breaks down, something that you're not really planning for. You can pull that money easily from your emergency fund without having to put an expense on a credit card or pull money out of your retirement account where it's going to affect your long-term wealth building capabilities. So again, with number two, after your 401k match, you want to build up your emergency fund, and ideally in a high yield savings account where you can earn interest on it at the same time. How much you keep in your emergency savings account really depends on a couple things. Number one, I would say, is job security. So if you're in a stable job and you don't see yourself being at risk for layoffs or anything like that, you may lean towards 3 months of savings because there's not a whole lot of risk that you're going to actually need that money in the event of a job loss. If you are in a less stable career, maybe a sales position or the tech industry, which can be a little unstable at the moment, you may want to err on the side of caution and save 6 months or even 12 months in some cases if you want to be extra safe for your emergency fund. The other thing to consider would be your household income. If you have 2 people in your household earning income, the chances of you both losing your job and having zero income is a little bit lower than a single earner. So if you have 2 income earners in the household, maybe you just want to have 3 months set aside. If one person is a stay-at-home parent, then the single earner is going to be the sole provider for the household. So you may want to have closer to 6 months or more in that emergency fund. Third on the list on where to put your money after your basic living expenses are met is consumer debt. So high interest debt like credit cards or any personal loans. Rule of thumb I always say is if the interest rate is over 7% or so, then you want to pay that down before investing any money in the stock market. The way you can look at that is getting a guaranteed rate of return that's equal to whatever your interest rate is, because any money that you use towards that debt is going to save you that amount of interest in the long run. So again, 7% or so, if your interest rate is higher than that, which it is for most credit cards, you would want to put any extra cash towards paying that down before moving on to the next step. Fourth step would be an employee stock purchase plan. If you have access to one, they're not super common like 401ks are, but an ESPP allows you to purchase your employer's company stock at a discount. It's a max of 15%. In most cases that I've seen, it is exactly 15% of a discount that you get. So if your company stock is trading in the open market at $100, you have the ability to buy it at $85. So you're getting that instant discount. There are certain stipulations to how long you have to hold on to that stock in order to get the full tax benefit of the discount. That I'll cover in another video. But keep that in mind, you're basically getting a free discount on that company stock. So if you sell it later, that's money in your pocket that you wouldn't have had otherwise. So take advantage of your ESPP. If you can contribute up to $25,000 per year into that. So you don't have to max it out before moving on to the next step, but something that you should definitely look into for that discount. Number 5 on the list is contributing to an HSA or a health savings account. HSAs have tax benefits that no other account has. So Number one, contributions to an HSA are tax deductible, so you don't pay taxes on that income for that year. The growth and earnings on the investments inside of an HSA are tax-free, and withdrawals for qualified medical expenses are also tax-free. So HSAs combine the benefits of a pre-tax account like a traditional 401k and the after-tax benefits of a Roth IRA or Roth 401k on the back end. So no other account has both of those, which is why an HSA is number 5 on the list. Now, there are relatively low contribution limits to an HSA, so this is a pretty easy one to check off. I'll put the numbers on the screen now for 2024 as far as the annual maximums that you can contribute. But since we all will have medical expenses at some point in our life, an HSA is definitely something that makes sense to take advantage of. Now, an HSA does require that you be enrolled in a high deductible health insurance plan, which is not for everyone. So if you're someone who has frequent doctor visits or medical conditions, then it may make more sense to be on a different type of health plan where you would not be able to contribute to an HSA. So just keep that in mind. You have to be on a high deductible plan in order to contribute to an HSA. Number 6 on the list, after you've maxed out your HSA, you want to go back to your 401k plan. So max out that 401k where you can. They have pretty high contribution limits. For 2024, it's $23,000, an extra $7,500 if you're over age 50. So because those contribution limits are relatively high compared to other types of accounts like IRAs, 401ks is the next step to take advantage of those tax benefits, whether it be pre-tax where you get to deduct that off your income. That may make sense if you're a high income earner, or a Roth 401k if your company offers it, after tax contributions, so better for your lower earning years, and then all those withdrawals are tax free later on. So next order on the list again is to max out your 401k before moving on to number 7. Number 7 on the list is a Roth IRA, which is again different than a 401k. An IRA is an individual retirement account. It's not associated with your 401k. So a Roth IRA has the same benefits as a Roth 401k, after tax contributions, tax-free withdrawals later on. It does require that you have the money in the account for 5 years and you're over age 59 and a half, so that when you withdraw those earnings and growth that you get on your contributions, that is all tax-free. So you do have to meet those 2 requirements for a Roth IRA. But the reason you would want to contribute to a Roth IRA next is that even if it doesn't give you a tax benefit up front, again, all the growth and earnings is tax-free. So the next one that you'll see is a taxable brokerage account that doesn't offer that tax-deferred growth or tax-free withdrawals. Now, depending on your income, you may not be able to contribute directly to a Roth IRA, in which case you would do a backdoor Roth if you're able to. That's where you make a non-deductible contribution to a traditional IRA, which doesn't have any income restrictions or limitations, and then you convert it to a Roth IRA, which is non-taxable since you already pay taxes on the money that you contributed in the first place. Now, with a backdoor Roth, you want to be mindful of the pro rata rule, which states that all of your traditional IRAs are consolidated for purposes of the conversion. So if you have any pre-tax dollars in a traditional IRA, when you go to do your backdoor Roth conversion, some of that could be taxable. So a common way around that is to take your pre-tax dollars and roll it into a 401k if you can, so that it's not treated as a taxable conversion. 401ks do not count towards that pro rata rule. And side note, make sure you invest that money in the Roth IRA. It's not the same as a 401k where your money is automatically invested in something. I see it all too often where people put money in a Roth IRA, look at it years later and wonder why it hasn't grown but a few dollars. And that's because with an IRA, you have to invest that money yourself. It doesn't get automatically invested unless you're enrolled in some kind of robo-advisor program through one of the major brokerages, or you have an advisor that's going to invest it for you. But just keep that in mind. That's a very important step when you're using a Roth IRA. After you've maxed out your Roth IRA each year, you can then add to a taxable brokerage account. Brokerage accounts are great because they don't have any income restrictions, they don't have any contribution limits, they don't have as much tax benefits as IRAs, so your dividends, your interest, and your capital gains will be taxable in the year that they are realized, whereas IRAs, they're deferred till later or not at all. So a taxable brokerage account, more flexibility, a little bit less tax advantages, but the main thing here is that you can add as much as you want to these accounts so that you can, have extra retirement savings, use it as a medium-term goal, like maybe purchasing a house in 5 to 10 years. So they can really be used for anything. There's never penalties to withdraw from taxable brokerage accounts. So they sometimes are called the Swiss Army knife of investing accounts since they can be used for pretty much anything. The next two on the list can really be mixed into any order of the list that we've already gone over. It really depends on your personal situation, your priorities, and your goals. So number 9 I put as short-term goals, meaning anything within the next 5 years. So if you want to save for a vacation, buy a house, save for a down payment on a car, anything shorter term you can set aside either in a high yield savings account or maybe a conservative investment portfolio. Again, this really depends on your unique situation, so there's no right or wrong here. You can kind of mix it in any order depending on what your priorities are. And last on the list would be any low interest debt, such as a mortgage. If you have a mortgage rate that's 5% or less, it may or may not make sense to pay that down depending on how much extra cash flow you have. If you already have plenty saved for retirement and you decided that you don't really need to bolster that savings anymore, you can put that money towards lower interest debt like personal loans, student loans, or a mortgage. That'll get rid of that debt quicker and reduce your monthly expenses in the long run. So lower interest debt, again, last on the list because generally you can earn more than whatever that interest rate is in the stock market. So for example, if your mortgage is say 3%, contributing to a taxable brokerage account, generally long term will give you a better return than that. If you invest in the stock market, you can expect 7, 8, 9% long term. So that's why mortgage and low interest debt is kind of last on the list. But again, this whole list is dependent on what's in view. The emotional side of investing also comes into play too. So hope that was helpful. Hope it gives you some guidance on where to put your money after you pay your living expenses each month. Again, there's a general order that makes sense for most people to take advantage of all the tax rules with all the accounts, making sure that you're maximizing your wealth building capabilities. I also created a free PDF that you can download. There's a link in the description, so be sure to click that and download it just for easy reference if you want something to look at rather than going back and looking at this video. And as always, if you want to learn more about us, visit us at sparkwealthadvisors.com. Thanks for joining.